very timely moment to discuss financial regulation. The COVID-19 crisis is not a financial crisis. However, it highlights the need for rebuilding the financial system in a different way. The aim is not only to build a system less vulnerable to financial crises, but more effective in promoting financial tools to help countries in their journey towards economic recovery, fostering innovation and productivity, promoting decent jobs, social inclusion, and especially fighting climate change. The research is about discussing if Basel III, the current financial framework, constrains or not national development banks regarding their ability to fulfill their mandates. The paper does so by comparing three large bank experiences: KfW, the German bank, China Development Bank, and the Brazilian Development Bank. First, the paper recognized that compliance with the Basel framework has brought tangible benefits to national development banks, including better and integrated risk management systems, access to capital markets, and especially greater bank autonomy to face political pressure. However, some specific Basel III rules require attention. Concerns involve the disincentive to the use of internal models, more suited to the development bank characteristics, the new large exposure rule, which is problematic given development banks' focus on large infrastructure projects, the high-risk weights required for project finance and equity, which are tools to support complex projects and innovation. And last but not least, the Basel framework still needs to be enhanced in order to consider climate risk as a systemic risk, remove the indirect forms in which it currently discourages long-term green finance, and go further by creating clear incentives. By looking deeply to Basel III recommendations and methodologies, this paper can help development banks to argue with national regulators in order to develop tailored rules to be designed taking account of particular forms of ownership, funding structure, and business models. Alternatively, the paper can be a step towards defending a different regulatory frameworks for development banks at the global level. As the paper claims, although development banks are quite different among each other, they share many common features, like they leverage less, do not engage in complex securitization, do not have large liquidity risk, use derivatives only to hedge their operations, operate less procyclically than other banks, and they do not take profit-driven excessive risk. An international framework could help protecting development banks against political intervention. Finally, many development banks have long and large experience in financing green investments. Maybe it is time to enhance the dialogue between national development banks and regulators.